Today, we're going to talk about using life insurance as a retirement planning vehicle. And before you shut this off and run, I want to tell you why I'm talking about this, because there's been a celebrity in late October 2025 that came out with a word of warning about this. And I think it's really important that people that are close to retirement, or that anybody really that has been heard of this concept of using life insurance for retirement planning, listen, because it's going to be an interesting show. Let me bring in my co-host to make it a little bit more interesting. Welcome to the show, Tony.
Well,
We're going to be talking about using life insurance as a retirement planning vehicle. And what I want to do is share with you guys, the listeners, and Tony, I'll probably have you read it because I'll admit your voice is better than mine. We're going to
all
talk
right.
about Kyle Busch. Do you know Kyle Busch, Tony? Do you know who this guy is?
A race car driver, right?
Yes, he is.
Heir to the Busch race car driving family, right?
Yes. Successful race car driver. Him and his wife made a post on Twitter or X or whatever you want to call it. But I want to go through what that is. But before I do, Tony, I want to introduce this with a quick little video.
Time for the bad financial idea of the day.
So
I
for
love
those
that.
are listening on iTunes, Spotify, wherever, that was a video of Tony signing what looked like to be a deed of the Brooklyn Bridge. So today we're going to talk about a bad financial idea that is brought to attention by Kyle Busch and his wife Samantha. I'm going to share my screen, Tony. Why don't you go ahead and read what he posted, because I think it's going to be quite relevant to hear it in his words before I get into my take on it.
Sure. Do you want me to read the full post that he posted?
You could, yeah, why
All
not?
right.
It's not that long.
Yeah. Kyle Busch posted this. We've always tried to take the hardest chapters of our life, infertility, loss, setbacks, and use them for good. Today is one of those moments. We are sounding the alarm on a hidden insurance scam involving policies being sold by Pac Life and other insurance carriers. These are being pitched as smart retirement planning or a way to set up your children's future. But too many families are being misled and left with devastating financial loss. It's not just public figures, it's everyday hardworking Americans who trusted the system and are now left with little to no way to recover what was taken. We're sharing our experiences so others don't have to go through this without warning. We were misled. If you've been approached with a no-risk retirement plan tied to an indexed universal life product, an IUL, run. Your future matters, your family's security matters. You deserve transparency. And those are Kyle Busch's words in his post. We are
Right.
not attacking any one particular company. He did mention Pac Life and other insurance carriers there. But it sounds like, Dan, he lost some money. What's this? I don't know. Before you told me about this morning a little bit and shared that post with me, I didn't know what this was about, and I'm not quite sure I understand the issue here. So maybe you could fill us in.
Yeah, and for the viewers, you can go and look at that post yourself. There's a video on there with him and his wife explaining their side. So we're only getting their side, but bottom line, I want to highlight that, Tony. We were misled. And if you've been approached with a no risk retirement plan tied to an index universal life, IUL, run. So I just looked it up because I forgot how long ago it's been. I did a video on this topic 9 years ago, Tony, 9 years ago. And I remember vividly getting calls from people around the country that watched that video and asked me some questions about their universal life policy. And I there were two that I remember vividly. One was I think he was in his 30s, a young guy who was pitched that his life insurance policy would be a college savings vehicle for his young daughter. I believe she was like 6 at the time that he called me. He had bought the life insurance policy when she was 2, and it was designed when she went to college that he would be able to pull money out tax-free to pay for college. And
Sure.
he's been funding it, and he went through it with me, and it wasn't working as planned. So he wanted my opinion on it. I also remember a person that was in Germany with their father who bought a life insurance policy in the US, emailing me about how their universal life policy has just gone out of control and blew up. And that was the video that I'll put it up there if you want to watch that. It's about how universal life policies can really blow up in your face and become completely unmanageable, expensive, and a waste of money if not designed properly. So back to the Kyle Busch situation, I decided to read the actual lawsuit. It's a 50-page document that I can't get now. I read it last night because I saw a link to it on some sports writer who downloaded the PDF version of it. And I read through all 50 pages. You know, I'm a geek, Tony. I know, I wasn't even trying to fall asleep. So I jotted some notes down, but when I went back today to look at it, it was gone. So, and I'm not going to go pay to get this it's public records, I guess, but I'm not about to go pay to get it. But as I was reading it, I'm like, yeah, I understand where this is going. So the bottom line is roughly the Bushes put in 10 million into this life insurance policy. So I think they got it in the 2022 or something like that. I don't recall, but it's been a few years. They put in about 10 million, and they claim they now, as a result, have lost 8 of those 10 million on this situation.
How long ago did they put the 10? How long ago?
It doesn't say, and it doesn't say. I can only assume that they were putting in a few million a year for maybe
Sure.
They put in 2 million a year for 5 years. I don't know, or unless it was all at once. I don't think it was all at once. And then the question is, well, how do you put in 10 million and lose 8? Like, and especially in this market.
That's my question. Yeah, how I don't understand, because I've heard these things pitched, and I've talked to financial people who say, "Oh, this is a pretty good option for tax-free money in retirement, or to use for they pitched it to them college, and there's still a death benefit that you can tap into your cash value and the death benefit, maybe use it for long-term care or for your kids' college." So I've always heard it and thought, "Oh, that sounds really good."
Right.
It sounds good. I am not an expert in any stretch of the imagination in life insurance, so I never claimed, I always thought, well, if you put 8 million in, you'd get at least you have at least 8 million coming back to you at some point,
right?
In one way or the other,
right? And they talk about an indexed universal life. So what that means is a universal life, which is a type of life insurance policy that's flexible, that has moving parts. Index means it's that your money is put in there and it's tied to an index, like the S&P 500, right?
Yeah.
So you immediately say, well, if it's tied to an index and he bought it in the last decade, I mean, really, how do you go wrong?
My goodness,
unless
it should be the indexes have hit record highs, like the Dow and the S&P 500. So, but isn't that I know when you're talking about another insurance product, like a fixed indexed annuity, that's tied to the S&P, but your principal is supposedly protected. In an index universal life, isn't the principal, the amount they put in, protected?
Yes. So the question, well, how did they lose? Right? Of course, the devil's in the details. These can be complex, so you have to watch out. But and I don't know, but I'm going to guess it's one or two things. One, they were doing what's known as a premium financed life insurance, meaning they were putting in money, but they were leveraging it with a bank loan to really put a lot of money into it. So maybe the death benefit was hundreds of millions, and they were putting in 8 and they were borrowing 50 million from the bank. So okay, so now we could see, oh, that's great. Now I'm going to put money in and it's going to grow. I'm leveraging the bank and we're going to make such great returns. because the indexes are going to go crazy and we're going to get a great return. And yeah, I'm paying interest on the premium that's going in alone, but it's going to outpace that unless it doesn't, unless the index doesn't. But you're right. If the index goes down, they're not going to pull money out. What the insurance companies always do is you got a death benefit in there, and that's not free. Someone's paying for the death benefit, right?
Yeah.
And so there are costs that come out in good index performance, bad index performance. Those fees are always there.
Yeah, the premiums.
So
the premiums on the death benefit are always there.
no, on top of the premiums, there is a fee for the death benefit. So you might put money in, and this was the problem in the 1980s, and this is what I did the video on is, okay, Tony, $25 a month, and you're going to have a $500,000 policy, and by the time you're 90, you'll have so much cash value in there. The problem is, as you get older, the cost to insure your life goes up. The idea is the cash value in there is going to pay for that if you put enough cash value in.
Right.
So it could be the case that they didn't put enough in and then the cost got up. But on something that's such short term like this, I'm thinking there's another probable solution or reason why this thing lost them money. It's because they probably surrendered it and pulled all their money out because they saw the writing on the wall, like, oh, this was pitched to us to look like this, but now that we understand it, this is not doing anything like we expected. We want our money out. And the insurance company says, well, there's a surrender penalty. And those on these types of products, they're usually at least 10 years. So if you're pulling your money out early, you're getting hit with a huge penalty, which could have been the $8 million loss, which was the surrender charge. So that's how you can see you can lose something on this, not from the index poorly performing. It's from surrendering it and getting hit with a penalty. So that's the problem that I think has happened. But why would they surrender it? Why would they do that? It's because they're saying, and then I read the lawsuit, it's like, well, they were misled. They were told it was going to do this. They told it was going to do that. I also read in there that, and again, this is just their side of the story. They're saying that the agent did what's known as a 1035 exchange, which means he sold them the original policy, and I think they said in a couple of years later, he surrendered that policy and got a new policy with the same company because it was better, right? It improved their situation.
Oh.
Okay, maybe odds of that are low because you have surrender penalties when you surrender, right? So you surrender something right away. How much better could it possibly be? What it does do, Tony, is it resets the surrender period. So now you've got to start all over again on the high surrender charges.
Plus,
because you got a new
is
policy.
Probably being paid by the insurance company for each policy, and so that's why they reset. So when I'm going to move, we're going to get rid of this, and you're in this annuity or this life insurance policy, but I'm going to move you into this newer policy because it has better features. And people are like, oh, okay.
Right.
But what they don't realize is they're rewriting business maybe with another company and getting paid all over. They're getting a fee from the insurance company for writing that new policy. And so that's how they get paid. So they keep moving it around, even though it's costing in the long run the person a lot and extending the surrender period.
It's resetting the surrender period all over again.
So
new charges.
If what they say is true, it's probably somebody, a so-called financial person or an agent for an insurance company misleading them, right?
And that's the case. And that's what they're trying to outline, and the lawyers are outlining it. They're blaming the agent for misleading, misrepresenting, churning, or putting them in for his best interests rather than their own. They're suing Pacific Life because the agent is a representation of them, and they were being pitched as, hey, this is a retirement and a tax planning thing. And meanwhile, it's just an insurance agent. So I'm getting advice about things that aren't really in their purview.
Right.
And that it was designed for the benefit of the company, not the client. And we don't know how this was designed. I'm only guessing, but this is what I've seen. I've seen people, they've come to me with their policies that they already own and say, can you give me your opinion on this? And when I start analyzing it and say, this is what it's probably going to look like, they're like, well, that's not what was sold to me. I was told this. But things change. Interest rates change. That could have had a huge impact on this. Who knows when they got it and what the interest rates were. The caps, oh, the market was up 30% that one year, and we only got 11. Why? Because the index has got a limit on the top. If they're going to limit you on the bottom, you know they're going to limit you on the top. So the bottom line on this is that it was probably a poor design, and the interest rates on the loan, maybe if there was a loan, got out of hand. The fees or the charges within were reset or went up or were different than what was expected. And maybe the performance wasn't as great as they thought it was going to be. And so they were disappointed. And most likely were so disappointed that they said, I want my money back, took the big hit. They didn't want to pour any new money back in, more money, chasing bad. And they made the decision to call it quits. So Tony left. He was so disappointed with this discussion that he just couldn't take it anymore. He left. So I'm going to do a quick conclusion here. I don't know the details of this case, but I'm guessing from experience what happened. And the Bushes are really going after this company in public. So they must feel they have a strong case to be slanderous in a way about what happened. I'm going to pay close attention to this because it's in the retirement space, and I don't like when people are misrepresented or things are done poorly. It's part of life, but you got to be careful. So life insurance could be a useful tool when it comes to retirement planning. You're looking at wealthy or high net worth people because they're at the high tax rates. They're looking for a way to avoid taxes or lower their taxes, and life insurance can do that. But you really have to know what you're doing. You have to design it well. And for the average folks out there that are buying these to pay for college or as a retirement additional income, you got to be careful because it can be misrepresented, and just don't jump headfirst into something unless you truly understand it. So that'll do it for today's show. Thank you again. If you have a life insurance policy that you're not too sure on, Dolphin Financial Group, we are an insurance agency. We'll look at it, tell you what we see, what we think, and give you an opinion. It's always good to keep checking on these things. If you own one, every year, talk to your agent and make sure it's doing what it said it was going to do, because the key to fixing it is early detection and early corrections, which you can do in most cases. Just sometimes you get frustrated and make a rash decision, and maybe like the Bushes did, they got hit with a huge penalty that could have been avoided, and maybe if they changed it a little bit. But I don't know. We don't know. We'll find out, and we'll bring it up again. Enjoy the rest of your day.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.